Welcome to this lecture on tax losses. A word of warning. If you have not worked through lecture 1 of IAS 12, you will struggle with this lecture. It is important that you are familiar with your basic principles of income taxes before you continue watching this video. Right, now in this video we are going to focus on tax losses and tax credits. I am going to explain to you the principles by means of scenarios where we are going to look at the effect on our current tax and our deferred tax, as well as our presentation and disclosure in terms of our income tax expense note and our deferred tax note. Now first, what is a tax loss? Now, if you look at our current tax calculation template, which we've covered in our previous lecture, remember this is our calculation. You will start with your profit or loss before tax, and this is in terms of your accounting rules. You will have to take out your accounting rules and include your tax rules and calculate your taxable profit or loss. Right, now let's say, for example, that I have registered my own firm, and this will be Bianca Nell Auditors. And this is my first year of trading. In the first year, I started trading during the COVID pandemic. Therefore, in the first year, I recognized a taxable loss. Look at this, a taxable loss of 100,000 Rand. Therefore, I'm not going to pay any taxes. This is a loss. But now, if you think about this, I would want to use this loss in future when I recognize a profit. Now, the standard indicates to us, and when you look at the left side of your screen, the standard indicates to us when there is any unused tax losses or unused tax credits, to the extent that it is, look at this, probable that future taxable profits will be available to utilize, to be able to use those losses. The standard indicates to us we may recognize a deferred tax asset. Now, if we just recap our principles here, if you refer to the word recognition, this relates to your journal, recognize. If you refer to the word measurement, this relates to your calculation. Therefore, if I'm able to prove that I will have profit in future, I may recognize a deferred tax asset relating to this 100,000. Therefore, if I recognize my deferred tax asset, I will debit my deferred tax asset in my statement of financial position and credit my deferred tax in my profit and loss. And let's say that we have a tax rate of 28%, therefore this will be 28,000. Right, now let's have a look at the current year, which is our second year of trading. In the current year, we have calculated a taxable profit of 250,000. Apologies, I've identified that this should include loss as well. Right, 250,000. Now, in the current year, we may utilize that 100,000 relating to our prior year loss because we've recognized a deferred tax asset. Okay. And our taxable profit will now be 150,000. Now, what is a capital loss? If you look at the standard, it indicates the tax credits, tax losses. A capital loss will be when you sell an asset and there will be a loss relating to that asset sold. Okay. Now, let's have a look at the effect of a tax loss on our current tax calculation relating to our deferred tax calculation. When you look at the left side, we have just discussed our current tax calculation, you will remember, where we've identified that we have a taxable loss of 100,000, and in the current year, we utilize and use that 100,000. Now, when we recognize our deferred tax asset, This will be included in your deferred tax calculation. Remember, this is your templates. And remember that I'm focusing on the important principles that you need to know to be able to pass your tests and your exam. Now, when you look at your deferred tax calculation, in the prior year, the year in which we have recognized our deferred tax asset, we include a line, unused tax loss. And this is 0 for accounting purposes. Remember, your carrying amount relates to your accounting principles, your tax base to your tax principles. This is 0 for accounting. But for tax, we have a tax base of 100,000. Since I had COVID, you will identify that I start to lisp very quickly. Okay, right, we have a tax base, and then this will result in a temporary difference of 100,000 and our deferred tax asset. Therefore, we create our deferred tax asset, debit deferred tax asset of 28,000. Now, in the current year, look at this. In the current year, the year in which we use that 28,000, identify that we do not have a line item included here relating to the loss. There is no line item relating to that loss because we now use that 28,000, 100,000. Therefore, that amount will now be 0. Okay. When you look at our current tax calculation, you will identify that we deduct the 100,000 from our taxable profit. And this decrease our taxable profit to 150,000. Right. Now, you will also remember, in terms of our deferred tax, I have recommended that you always divide your movement, which is your current year minus your prior year, into your OCI, your profit and loss, your unused tax loss, and your change in your tax rate. Now, when you look at this, remember, in our current year, we use the deferred tax asset. Therefore, if we use the asset, our deferred tax will be credited because this will decrease. If you think about your T account, an asset, increase on the debit side, decrease on the credit side. And we will debit our deferred tax in our profit and loss. Right. Now, in terms of our disclosure, if you look at this on the left side, I've included a copy of my current tax calculation as well as a copy of my deferred tax calculation. And then on your right side is our income tax expense note. We have discussed our current tax calculation as well as our deferred tax calculation, but now I want to indicate to you, how do we include this in our note? Right. Now, if you look at our income tax expense note, in the prior year, okay, before we look at this, let's just recap something. Income tax expense. Remember, if you include your T account, this is an expense account. It increase on the debit side and decrease on the credit side. If you look at a note, you will identify the income tax expense at the bottom. If it's an expense, it will be positive. This is a note, guys. This note supports our amount in our profit and loss statement. The amount in our profit and loss statement will be included in brackets as a deduction if this is an expense. Don't get confused with this, please. Therefore, you will identify the signs might confuse you, but focus, this is an expense account. Therefore, increase on the debit, decrease on the credit. Okay, let's have a look at our prior year. In our prior year, we create the deferred tax asset. Therefore, if you look at the bottom, our journal, we debit our deferred tax asset. We create, increase on the debit side, and we credit our deferred tax in our profit and loss. Therefore, if we credit our deferred tax in our profit and loss, If you look at our T account, we credit minus. Therefore, include your brackets. We credit. Right. We decrease our income tax expense because we provide for a future receivable. Okay. Now, in our current year, look at our current year for me, please. In the current year, we use that 28,000. Therefore, we credit our deferred tax. We decrease our deferred tax. And we debit our deferred tax in our profit and loss. If we debit, now don't get confused with my signs here, guys. I've just included this as a bracket because it helped me to understand the use. But if it confuses you, you are welcome. Take out your brackets. Focus on the debit credit. The debit the credit, please. Okay. Right. Now, if we look at the debit, we debit our deferred tax and our profit and loss. Remember, an expense. Therefore, an expense account will increase when we debit. Therefore, a positive. Okay.